Hello everyone, welcome back to Investing Sucks. My name is Eric and thank you so much for tuning in. So a little over 2 months ago, I did my first ever stock analysis video that I posted on this channel, and it was about Shopify, and the video was titled Don't Overpay for Growth Potential. And the reason I made that video wasn't necessarily to call out Shopify and call them a bad investment, but it was really to just point out to younger beginner investors that a company like Shopify, their valuation is extremely growth dependent, and you do potentially run the risk of overpaying for this company if they can't live up to those lofty growth expectations that people have for them. So when I made that video, Shopify's stock price was around $1,450 a share Canadian. And since then, since about 2 months ago, it's gone up to $1,900 per share Canadian. So over that time, it's actually added $52 million to the company's market cap in a span of only 2 months. And predictably, I did get a lot of criticism for when I made that video, with a lot of people saying that my revenue growth expectations for Shopify weren't as high as they should have been, which is fair criticism. I mean, a lot of people are going to have different opinions on that. Now, one thing that I didn't cover in my last Shopify video was actually doing an in-depth valuation of Shopify, where we take future scenarios of revenue growth and free cash flow growth, and then try and see what type of an investment return we could expect if we buy the stock today at its current price and hold it for about 7 to 10 years. So the goal of this video is going to be simple. It's to create an analysis that takes future scenarios of revenue growth and free cash flow growth, and then tries to estimate what type of a return you could reasonably expect to get if you buy Shopify today at its current valuation and hold it for 10 years. So we're going to be doing a 10-year analysis. Usually I do 7 years, but I wanted to make it a bit more longer term for a company like this, so we'll go with 10 years. And these future scenarios will cover a whole range. It'll be Shopify grows, say, a modest amount for the next 10 years, and then it will be the absolute bull case scenario where Shopify just goes to the moon the next 10 years and grows an insane amount. So we'll get the full range there. So, anyone who has varying growth expectations for Shopify can see, given those growth expectations, how much of a return can you reasonably expect to get? Now, before I go into the valuation model and start explaining it and go through it, I do want to say that I absolutely love Shopify as a company. I love what they do. I think their mission of, enabling entrepreneurs to have their businesses go online and sell to more customers around the world, it's an amazing thing, and they're helping a lot of people, and I'm really glad there's a business like them that exists. However, as we know with investing, any investment in any company, no matter how amazing the company may be, can still become a bad investment if you pay too much for it. So we'll go into the analysis now. Okay, so what I'm doing here is I'm using the free cash flow method. So I've got my assumptions up here. This is in Excel, and then I've got the 10-year analysis here. So I like to keep things very simple when I do it. So I just assumed a constant revenue growth rate of 30%. Now, I know that may seem low for the next few years, but this is 30% every year for the next 10 years, meaning the revenue in 2020 was about $2.9 billion, which was up almost 100% year over year. So I'm projecting in this that the revenue goes from $2.9 billion to $40.3 billion by the year 2030. So I think that is pretty aggressive, right? I mean, 30% revenue growth sustained over the long term. Obviously, it's going to fluctuate a lot. It won't be exactly that, but I think over the long term, it's an assumption, and we can kind of just put that assumption in and see what type of return we get. Now, I also have to deal with the share growth and buyback rate. So I'm assuming that shares will grow at 1% each year, which again is something that's very hard to estimate. It could change a lot just depending on if Shopify makes a very large acquisition, they issue a ton of shares to do that, or maybe way in the future they start buying back shares if they think their shares are well priced and it's a good way to deploy their capital. It all depends on various things, but just to be kind of more on the conservative side, I assumed 1% growth in total shares outstanding every year for the next 10 years. And then there's this free cash flow to equity as a percentage of revenue, also called the free cash flow to equity conversion. So this is the amount of free cash flow that the company generates that is available to the equity holders, so the people who purchase the common stock of Shopify. So I assume that's 25%. Now, to put that into perspective, in their most recent quarter, it was about 16.5%, 17%. So 25% is higher than it has historically been, but I think it does make sense to assume that this will grow into the future, because once they start doing more revenue, they can cover their costs more well, they achieve scale, they just become a more efficient company in general, so more of the revenue they generate just gets converted straight into free cash flow. So again, maybe that's a bit too high, maybe it's a bit too low. Obviously, people have different assumptions on that, but I think for the sake of this analysis and just visualizing things, it does work. And as you'll see later when I run through different scenarios, we'll change this number to see how that affects things. Now, one thing I do want to emphasize once again is the 2.5% free cash flow to equity yield in the year 2030. Now, this is a very generous assumption because this number here tends to go up over time as companies grow and they achieve more of their growth potential, which is exactly what we're projecting will happen here with Shopify. I mean, we're saying they're going to go from 2.9 billion in revenue in 2020 to over 40 billion in 2030, which again, some people may think that's not enough. Some people may think that's too much. Everyone's going to have different assumptions there. But a 2.5% free cash flow to equity yield, which by the way is calculated just by taking the free cash flow to equity divided by the actual market cap of the company. So if you were to think of it like a price to earnings ratio, and then say you would invert the price to earnings ratio, so instead it would be an earnings to price ratio, and then replace earnings with free cash flow to equity, that's essentially what free cash flow to equity yield is here. So very key assumption, just wanted to make sure everyone kind of understood that. So under all those assumptions I just made of future revenue growth and how much of that will get converted into free cash flow and what their share growth will be, we basically get this stream of cash flows. So we would say you would buy them today. This is in USD, by the way. They report their currency in USD, so I decided to just use USD for it. Their shares in USD are about 1.5 thousand. And then we would estimate you get this stream of cash flows here. So this is what we're kind of projecting in the future. And then the terminal value per share is calculated by taking this number here, so free cash flow to equity per share in 2020, divided by that 2.5% free cash flow yield. And then you get this kind of as your terminal value. And then we put that into an IRR calculator and you get an 8% IRR. So when it comes to estimating IRR, what we try to do on this channel is we look for an IRR estimate of at least 15%. Because if you're going to be investing in an individual company, you're taking on what's called unsystematic risk, right? It's the risk that is present investing in just one company as opposed to just systematic risk, which is the market as a whole. So you want to be compensated for taking on that additional risk. So you want to expect a higher IRR. Now, some people are going to disagree with those assumptions, obviously. So now what I'm going to do next is put in different assumptions. So more aggressive revenue growth and more aggressive, how much of that revenue gets converted into free cash flow, and then see how the IRR changes. Because our goal is to get at least 15%, right? Because then you can expect by making this investment that it'll outperform the market over the next 10 years, right? That's why you would invest in an individual company, because you have a pretty high conviction that it'll outperform the market. So I'll show you that now. Okay, so up here, this section is called the IRR sensitivity analysis. So what I have here is different compounded and revenue growth rates. So what I've included in brackets here is the number that revenue grows to in the year 2030, given all these different assumptions here. And then what I've included over here is how much of that revenue gets converted into free cash flow to equity, right? That's what you want. That's how you make your investment in these types of companies. So I kind of took the mid-level scenario here, which was about 40.4 billion, so 30% revenue growth rate every year, and then a 25% conversion. So that gives us an 8% IRR, which is what we calculated. But if we assume that the free cash flow to equity conversion is 30% over those 10 years, then the IRR goes up slightly. It goes up to 10%, which is more in line of what you want. But like we said, we're aiming for 15. So in order to get 15, we're looking at these scenarios here. So what do we need in order to get a projected market-beating IRR? Well, you're going to need revenue to grow at least 40% a year. Again, that is quite a lot. So we're basically assuming under that the revenue grows to 84.7 billion by the year 2030, which it could. I mean, it's definitely possible, but keep in mind last year they did 2.9 billion after having gotten a boost from that thing that happened in 2020 that forced a lot of businesses to have to move online. And if we look at it, say, on a free cash flow to equity conversion, you're going to need at least, you could get, if it was 20% free cash flow to equity conversion, you're going to need revenue to grow very fast. So at least 45% a year. But say it's being converted at 25% of revenue, then it doesn't need to grow quite as fast. So that's kind of how this analysis works. There's a bit of a trade-off there. So the goal for you as investors is just determine what kind of here is reasonable. Again, assuming you agree with all the previous assumptions that I made, which was 1% growth in shares, and still that 2.5% free cash flow to equity yield in 2030, which is essentially saying they're going to be selling for 40 times their free cash flow in the year 2030, which some people may think that's too high, some people may think it's too low. It all depends on what assumptions you make. So now I've put a little recap in down here, and I have different cases. So what I've called a rational case, which this is my opinion of what is rational, which is 30% revenue growth. So revenue goes from 2.9 billion in 2020 to 40.4 billion in 2030. Your IRR estimate, depending on the different free cash flow conversion rates, is 6 to 10%. So again, not really that enticing. And the reason that that IRR has been driven down recently is because of the recent boost that the company has had in their share price, right? They have gone up quite a lot in the past few months, like I said at the beginning of this video. And then let's say if we go a bit more optimistic, so 40% revenue growth every year for the next 10 years. So revenue goes from 2.9 billion in 2020 to 84.7 billion in 2030. Your IRR does go up, and it's more in the realm of what you want, so 13 to 18%. And then lastly, we have the moon case, which is basically, Shopify just takes over the world and just goes to the moon. So revenue grows at 50% every year. So it goes from 2.9 billion in 2020 to 168.9 billion. So just insane growth there in 2030. So just to recap kind of what that means, like what I'm saying there, revenue is growing 50% every year for the next 10 years. It's going from 2.9 billion in 2020 to 168.9 billion in 2030. Now, if you think that is reasonable, another data point I want to present to you is this down here. You're probably wondering what this is. So this is directly taken from Shopify's kind of recent investor presentation, and it's what Shopify's estimate, so this isn't my data here, this is directly from Shopify, of what their total addressable market is as of right now. Now obviously this can grow by the year 2030, Shopify could enter new markets, but basically what you're saying is that their revenue in 2030 will be greater than their current total addressable market is. That's just extremely aggressive, and you cannot really invest like that. You can't really invest in those types of things. Now, could it happen? I guess it's possible. Maybe we could have, the way they calculated this, by the way, is they just took their average revenue per user, multiplied it by the total amount of merchants in the markets they operate that they could, in theory, sell to. So, again, it's Shopify's number, so you would have to critique it a little bit. But, just assuming that their revenue is going to grow to a rate that's higher than their total addressable market, even if you assume their total addressable market will, say, double, even if their total addressable market, say, goes to 300 billion and they have 168 billion of that by the year 2030, that means they own over 50% of that market, which any company owning 50% of that market is just insane. To put that into perspective a little bit, Amazon, which is kind of considered the dominant, most dominant online retailing company, they own about somewhere between 40-45%, I can't remember the exact number, of the online retailing space. And they're considered dominant, right? And that's not even majority. So you're basically saying that in this market, Shopify would be more dominant than Amazon currently is in online retailing. And even if all that comes true, your IRR estimate, again, based on the assumptions I made, is in the range of 20 to 25%, which is obviously good, but it takes so much for that to happen. And again, this is just what the case is currently with the stock price being as high as it is. Now, here's another aspect that I'm going to start including in these stock analysis videos that I make going forward, and it's an entry point. So basically, let's say the stock price has a pullback in the next few months, so you can get it a bit cheaper than what it's currently at today. Again, this is all in USD, by the way, but the idea is the exact same if it was in Canadian dollars. And this is assuming the rational case. So how does our IRR over the next 10 years change if we can buy Shopify stock at a bit lower price? So obviously the lower we pay for the stock, the higher our IRR is going to be. But even say if it goes down to $1,000 USD per share, your IRR is only 12%. So that's not even at our 15% target. So really, if you're thinking of opening up a position in Shopify, if you're already in Shopify stock, you're in them for a price that's cheaper than this, then you're probably doing okay. You're probably not really sweating about whether or not their valuation is too much right now, or if you think it could keep going higher. You're probably holding them for the long term, so it doesn't really matter. But for those people who are maybe thinking of opening a position in them, this would be relevant information. And you always want to do this type of analysis when you actually come up with a IRR estimate based on what you value the company to be. So as we can tell here, Shopify's valuation is extremely growth dependent, right? I don't think that's really a surprise to anyone, but I think it is a very useful exercise to actually do the math and put things into perspective. Because as we saw, even if Shopify in some scenarios, they grow 30% in revenue every year for the next 10 years you still might not even beat the market over that term. I mean, obviously we don't know what's going to happen in the future, and since we are assuming things, it can get a little dicey sometimes. But that's really what you have to do as an investor in order to put valuations into perspective. And I know there's going to be some people who disagree with what I did here, and they're going to say, you know, you didn't take into consideration this or this. I get those comments all the time, which is absolutely fine. Obviously, there's so many different things that you can build into a valuation model. My goal is just to keep things simple here, right? Just two variables. How much does the revenue grow, and then how much of that revenue do they convert into cash flow? That way the model is just very understandable to everyone who watches, and it kind of helps them think about their investments a bit more. Now, before I conclude this video, I just kind of want to reiterate why it is I started a YouTube channel recently. It was about 5 months ago I started this channel, and kind of what my goal is on YouTube. So I started the channel because I saw a problem with the current state of kind of YouTube finance and investing channels, where there are a lot of very popular channels out there who weren't really giving their audience the investment tools they need to exceed as investors. For example, they wouldn't talk about valuations at all. They wouldn't talk about risk inherent in investments. They wouldn't factor in future growth expectations to the company's valuation, and then determine even if they grow at certain rates, are they still a good investment, which is what I tried to do here. A lot of channels were really just picking popular companies that they know a lot of people are probably invested in, and making videos just explaining how amazing these companies are going to be and how they're going to keep growing to the moon, and all you got to do is pile into their stock and everyone who watches this video is going to be amazingly rich. And obviously with a company like Shopify specifically, this is a company that is quite popular. A lot of people are probably invested in this company, and a lot of people have a lot hinging on the success of this company. And the goal of this channel isn't to just have contrarian opinions and say all the companies out there suck, everything's overvalued, and just shut up and buy index funds and you'll be fine. Because I do think that with a little bit of research, you can identify companies that will do well for you over the long term. It's definitely possible. But in order to do that, you need to apply a disciplined approach when it comes to investing, and you have to look at companies for what they really are, right? The fundamentals behind the business, the revenue, the cash flow, all that good stuff. You can't just look at businesses as ticker symbols that fluctuate up and down every day on Yahoo Finance. That's not really conducive to long-term investing success. Anyways guys, I hope you enjoyed this look at Shopify. I hope you found it useful. If you did find it useful, then please leave a like on the video. Also, if you're new to my channel, then I'd greatly appreciate it if you consider subscribing. I'm trying to grow this channel as much as I can. So if you could just hit that subscribe button, that would mean a lot to me. It'd help me out tremendously. And as always, I'll see you in the next video.